Hey guys, Eric Eichhoff from Fulton Realty. Thank you for tuning in tonight. We are doing a series tonight on being a real estate investor, specifically towards real estate agents. So, what are some of the benefits if you are an agent to investing? Now, I realize there may be people on this who are not real estate agents or who are not quite yet real estate agents. A lot of the advice that I'm talking about tonight I think will apply to anyone, but some of it is going to be targeted specifically towards real estate agents. So my hope is that you leave a comment. I have one of my business partners, Isaac, here. Isaac, can you say a quick hello?
Hey everyone.
Yeah, so if you hear another voice in the background, that's Isaac, who's helping me out answering questions. So please put any questions that you have. We're going to jump into a few topics, but we're going to save some time at the end to answer some questions and to deep dive into any of these topics that we're covering tonight. So we're going to range anywhere from how to get started to some of the next level stuff, to how to scale up your portfolio. So I just want to start. I want to jump right in and cover a couple topics, and then we'll kind of back things up a little bit. So I want to start with a scenario I have up here on the board. So let's say you are a real estate investor or a new real estate investor. And you have $400,000 of cash. You have two different options with this. You can, A, put 25% down on 4 homes worth $400,000 a piece. Or option B, you can put 20% down on 5 homes at $400,000 a piece. So the question is, what do you do? What is a better strategy? Now, a couple of things to consider. When you put 25% down, sometimes you may get a little bit lower rate. Also, if you put 25% down, you'll have more cash flow because you have less debt service. It's also a safer position. Obviously, with 20% down, you can get five homes instead of 4, so an additional home. So what is that worth? So I will tell you there's no right or wrong answer, but I'm going to give you my answer tonight. So let's jump in. So right here, I have some math up on the board. So we have the principal, interest, taxes, and insurance, PITI, plus expenses. So this is for option A, the first scenario, 25% down on 4 homes worth $400,000 a piece. So that $400,000 down payment gets divided 4 ways. Let's say this house. So the PITI, so this is at about $7,200 in taxes and insurance, and this is a 4% interest rate on $300,000 loan amount. You have expenses. Let's just say water. This is a duplex. You're paying for water and some maintenance, around $250 a month. You're managing this yourself, so you don't have property manager expense. You're making or your expenses are about $2,400. Now, let's look into the rents. So you're renting, it's a duplex, you're renting each side out for about $1,400 a month, so $2,800. Your cash flow, the $2,800 minus the $2,400 is $400 a month. So annually, for 4 properties, you're about $19,200, okay? Pretty good. So let's take a look at the other scenario. The other one is, again, your PITI, a little bit higher because you are only putting 20% down. So your leverage a little bit more. So it's $2,250. Your expenses are still the same because it's, we've already factored principal, interest, taxes, and insurance over here. So your water and maintenance expenses are still the same. So your total expenses, about $100 more under this scenario. So in rents, again, it's same kind of properties, each one renting out for $2,800 a piece in this example. So your cash flow is about $300. So you're about 25%, instead of lower. So instead of $400 a month, you're now only cash flowing $300. But you have an extra property. So your total cash flow is $18,000 for the 5 properties on an annual basis. So on a surface level, it kind of looks like the first scenario makes more sense, right? You get a little bit more cash flow than this scenario. You're a little bit safer. You're not as leveraged. So why then would I choose option B? What are we not thinking about that we're leaving on the table? So this is what I want to do. I want to flip the board here, and I want to talk a little bit about depreciation benefit. So let's talk about this. On a $400,000 purchase price, we can factor in something called depreciation. So this is an expense that you don't actually see in your cash flow, but it's something that you report on your taxes to the IRS. So what is it? So basically you're telling the IRS that the value of the building is going down every single year because it wear and tear, right? And so there's a formula for calculating this. It's a straight line formula. The easiest way to calculate it is 27 and a half years. Now there is something called accelerated depreciation where you can take certain components that maybe fail faster than 27 and a half years. Maybe it's a fridge, maybe it's carpet, maybe things that you replace. But for this purpose, we're just saying straight line over 27 and a half years, we're depreciating this building. So now what we're going to do is we're going to take a value of $300,000 on the building. Now wait a second, I thought the purchase price was $400,000. Well, the value of the land, we need to separate out the value of the land from the building because the government says land doesn't depreciate. It's been there for thousands and millions and billions of years, so it's not going down. So we have to divide out, we come up with a number and we say the land, an arbitrary number, the land is worth $100,000, the building is worth $300,000. Where did we come up with that number? We just made it up. But it needs to be a number that kind of makes sense. Sometimes looking at a tax statement and seeing how your local government establishes land value from property value is a good start. And sometimes the numbers fall in a range like this. So depreciation over 27 and a half years, like I said, on $300,000 is a little over $10,000 per year. So if you cash flow $3,600 per year, so like the scenario, the second one I was talking about, you have $7,300 actually in loss. So what does this mean? This means that you are getting $3,600 per year in cash flow, positive cash flow in your bank, but you're actually telling Uncle Sam that you're losing $7,300 on this property. So why is that important? Well, if you are a real estate agent, you can take this loss and attribute it towards other income. So what does that mean? Let's say you make $100,000 selling real estate because you're a real estate agent. You can now take this and you can attribute that towards that $100,000 income. So now you only make $93,000 according to the IRS because you've attributed this. If you are not a real estate agent and you don't make your money from the real estate industry, you cannot take this loss this year. So it's a carry forward. It just rolls over until you make money and then you can use those losses. So it's active losses that you can attribute towards other income. That's a huge, huge benefit for investing in real estate if you are a realtor. So now we go back to this example. So we're talking about if we flip the board back over, we are talking about the difference between like $1,000 in cash flow. But now the second scenario, we have about $10,000 of depreciation benefit. And if you figure out what tax bracket you're in, let's say you get taxed at a 30% tax bracket, and you calculate that, that actually flips the scale. And now option 2 is actually a much better option. But let's say we believe in inflation. Okay, we are in a market where the government is printing a lot of money. And what we're going to see is potentially more and more inflation. One of the things to protect yourself, the best vehicles to protect yourself against inflation is real estate. So real estate is going to continue to climb as inflation happens. So if you believe that we are in an economy where real estate is going to keep continuing its path upward, which from my opinion, I see the low supply and the increased demand and the lack of contractors to be able to build to meet the demand is definitely attributing towards upward growth in real estate. And let's just say, I'm located here in Minneapolis. We've seen appreciation of like 7, 8, 9% year over year. So let's just take 6%, maybe a more conservative number. If you believe in that, that means that with this extra property, you're going to be making about an extra $25,000 a year just in appreciation. So if you start to figure some of this in, this option 2 starts looking much, much more beneficial. So here's the thing. This is like simple math, right? We look at these scenarios and we figure out like, oh gosh, leverage is a good thing. Responsible leverage is a good thing. Buying more homes with less down is a good thing. I think that makes sense to a lot of people. But here's where I see people actually choose option A indirectly. They don't even realize it. What happens when you buy a portfolio of 5 properties and you just kind of sit on them and you start paying them down over time? Well, you start paying off a lot of equity. You start building a lot of equity through appreciation. And before you know it, you have a ton of equity sitting on the table that you do nothing with. And you don't go out and leverage that equity to buy more properties. So this is a way where I see investors just sit on a pile of equity without going to leverage it. And what I see is that you can really probably, with this amount of cash, with this amount of properties, and the current levels of appreciation, you could probably use the value that you're building every single year to buy another property, just from this nest egg itself. And so that is one of the things where I would encourage you. Yes, we're all going to choose option B probably, but don't let yourself accidentally slip into option A because you just buy something, you set it up, and you forget about it. You don't tap into that equity in a few years to go out and leverage, use good debt, buy another property. So I hope some of this makes sense. The thing that I wanted to talk about next is debt service. So when you're buying properties like this, banks you might say, hey, Eric, at what point can I stop buying properties? Well, banks, when you get to a certain point, you can only do like so many Fannie, Freddie loans. Really, the number is about 10 if you have good credit. Then you have to start going to the commercial world, and they start looking at something called debt service coverage ratio. So I want to share just a couple thoughts here. So debt service coverage ratio. The number that you want is about 1.2. So I'm going to give you a quick high level on this. So if you want to keep leveraging properties to buy more properties, this is something that you're going to have to take into consideration. So debt service coverage ratio is your net operating income over your total debt service. So what does this mean? Net operating income, that does not include your principal and interest payment because many investors, someone might buy cash, someone might buy 20% down, someone might buy 50% down. You got to normalize your net operating income, so we don't include that. Your debt service is taken into consideration in the bottom. So it's your rent, your net operating income is composed of your rent, your taxes and insurance, because whether you buy it finance or cash, you're still paying taxes and insurance, plus any other expenses that you have on the property, over your principal and interest. So let's just talk in the scenario that we were talking about. Your rent's of $2,800, your taxes and insurance on that, about $600 a month, and your other expenses about $250 a month, over your principal and interest, which is about $1,650. That gives us a debt coverage ratio of just under 1.2. So again, 1.2 is kind of one of the magic numbers that we hear from a lot of lenders that they want to see. So what would it take to get to 1.2? It would take $2,900 in rent, and you're pretty much there. So give each place a little bit of a rent bump, and you're there. So that is one of the things that lenders will start taking a look and judging your portfolio on a global, they say global cash flow basis, that is some of the numbers that they're looking for. So what I'm talking about tonight here is my experience from starting from one property when I was 19 years old to the point now where I'm at about 670 doors. Disclaimer, I don't own all of those doors independently. So I have partners on a lot of those properties. But one of the things that I wanted to encourage everyone here is that I look at the real estate world right now as sort of a land grab. So what does that mean? That means that, again, inflation is going up. Property values are going up. The name of the game right now is to buy as many properties as you can, to ride that appreciation. I'm going to talk about a couple of the mistakes that I made early on as an investor. So, when I was first getting into this, I thought that to be responsible, that I wanted to have a very short loan term. So most loans are 30-year loans. And then you can cut down to a 15-year loan. I thought it was more responsible to go to a 10-year loan, get it paid off as fast as possible. I also thought, I want to put as much money down as possible, right? So some of the things that I was just talking about. It's those things that kind of led me to having really stunting my growth early on. So most of my property acquisitions have actually happened in the last 4 years. So I've been investing really since 2009. So I've been investing for about 12 years, but it's just the last 4 that have really taken off because of things like I'm talking about with leverage and really focusing on properties being a stepping stone to other properties. So I want to talk a little bit about the roadmap for some of investors that are just kind of getting started. So what does it mean to buy something with the lowest down payment possible? Well, if you are a new investor and you have not bought a property yet, my recommendation is go after a 3.5% down FHA loan. So this is like, let's say you are a younger investor and you want to go buy a duplex, 3.5% down, owner occupy, live in it for a while, rent the other half out, then go and do that again, right? As many times as you can. You can only have one FHA loan, but there are other low down payment options. So exhaust those options first, right? Typically, the best way to start with something like a 4-plex, and then move to a 3-plex, and then move to a duplex. This is perfect scenario. This isn't something that everyone's going to do. The reason you buy down like that is because it's easier to convince a lender that you're moving from a higher occupancy home to a lower occupancy home. So they'll keep giving you those owner occupied loans, and you're taking advantage of as many low down payment loans as you can. This kind of leverage talks about what I was just talking about and puts it really on, it adds gasoline to it. It supercharges it. So that is probably the biggest advice. The other thing I was talking about is I would put things on 10-year loans early on. So my first criteria when I was getting into real estate, because I didn't really have any mentors. This was before Bigger Pockets existed. This is before some of those online, people were doing online webinars and seminars and blogs. And so I was just kind of learning as I was going back in 2009. My first formula was, did it cash flow more than the mortgage? So that was it, and if it had positive cash flow, that was a buy. So that was my first couple properties. Luckily, I bought in 2009. And anything you bought in 2009 is a good deal. But when people ask me, what is the formula that I should use now to start if I'm a new investor, I kind of have 3 things. So the first one is, does it, first of all, positive cash flow? Without a doubt, right? We don't buy anything that has negative cash flow. But how to judge positive cash flow? Can your property positively cash flow on a 15-year mortgage? Can it at least break even on a 15-year mortgage? Now, do you put it on a 15-year mortgage? No, you put it on a 30-year mortgage. Why? Because you get more cash flow, because you have a better lending leverage, so you look better to a bank to go buy another property. because your debt payments are lower every single month, and you'll get to the end game, whatever that is, much quicker. The other thing is buy it in a place where you would have once lived. So, or think about the building. Like, are you buying a building that you wouldn't have lived in, right? So, is it in a condition where you are not, you would have never seen yourself living in a building of this condition? If that's the case, you probably don't want to deal with the people that are okay living in that condition, or if you're not going to fix it up to that level. And the third thing is you want to make sure that it's in a place, position that if everything goes to crap, you can sell it, right? So can you sell it, and can you walk away with a little bit of money? So not a lot of money, but are you buying it for a good enough deal that you can pay off any real estate agent expenses, any other fees to sell, and get out of the property? So if you meet those three criteria, then I think you're in a pretty good place, and that should be some of the basic criteria for the first couple properties. People then ask, what are the criteria for other properties? And this is a tricky question, because there are simple answers, such as like, I'm looking for a 10% cash on cash return, or I buy something with like an 8% cap rate. You'll hear this term in commercial real estate all the time. Or something with a gross rent multiplier. I think the important thing to focus on is you have your own kind of rate of return that you're looking for. So let's say you have your own cash on cash return. This is the term that I talk about the most. Maybe it's 10%, maybe it's 8%, maybe it's 12%, right? So the cash that you get from the initial cash that you invested. So you look for that, and then once you hit that minimum criteria, then really start focusing what areas have the most potential for appreciation. Why I say this is because if I look at my history of buying property, I've made some decent money in cash flow along the way, but the most money I've ever made is in appreciation. And there's two ways to make appreciation. One is through riding the market up. Again, it's like the inflation market that we're going into. The other is something called forced appreciation. So what I mean by that means you're making improvements to the property to increase the value artificially. So there are certain things that you can do where you can bring up the rents slightly, or you can bring the expenses down slightly, and they make a dramatic difference to the value of the building. So if you're looking at a 4-unit building or under, think about expenses such as you would in a single family home. Think about increasing rents by making the bathrooms and the kitchens nicer, right? Think about those kind of things. Think about what will help you drive rents up. Something like replacing a roof, or something like making the building more efficient is not going to drive your rents, therefore is not going to drive the value of the building up as much. If you are more than 4 units, think for like balance sheet items. Think for things that drive the balance sheet. So really drive down on trying to get the expenses down, right? Maybe it's taking utilities that are combined and separating them and putting them on the tenants. Maybe it's, again, making the building more efficient, right? Those little changes to the expenses will have a dramatic value on the income statement. And when we're talking about 5 units or more, that is how buildings are valued. They're not valued based on a sales comparison approach. They're valued based on them being a business. So if you can make the business more profitable, and we have super low cap rates, it's exponential returns on the value side of things. So, the other thing I want to talk about is some of the benefits as a real estate agent. So again, I'm talking to the real estate agents right now of why you need to be investing in real estate right now, and why our industry is changing in a way that I think this will benefit you. So there's kind of some tangible and intangible. And any real estate agents out there that currently invest in real estate, I think you're going to know what I'm talking about when I say this. So the intangible benefit of investing in real estate as a realtor is it gives you a ton of confidence. It helps you know what you're talking about, and it helps you go get in front of clients and understand the product that we sell. I have met so many real estate agents out there that don't really know building codes at all. And do you need to know that to be a successful real estate agent? No. But is it helpful? And when you get those super specific clients that have questions, absolutely. And it gives you credibility to start networking with investors and start working with investor clients. So that is kind of some of the intangible. I think the confidence that it builds in you when you go through a project, when you invest your money in the product that you sell. So let's talk about the tangible benefits. So I see, the industry right now compared to about 10 years ago when I was getting into the business has changed a lot. Full service 10 years ago meant you took decent photos, you got it on the market, you responded to phone calls, you placed some advertisements in the newspaper, and you followed up with your clients and you had good communication. Full service in today's market as a real estate agent when you're working with sellers means you have 100 high professional quality photos, you have 3D tours, you have marketing that's optimized on Google and Facebook and all these social channels. Your office is open to answer questions and respond to tour requests really at all times. You have ways for people to get information on the property. But even more than that, I think one of the biggest changes that I see in the real estate industry is sellers want an agent that can do some pre-sales consulting and really be almost like a project manager. So they want an agent that can come in and give advice on how to stage the home, improvements to make, and then not only what improvements to make, but who to hire to get those improvements done. And in today's world, it is so difficult to find contractors. And as an agent that actively invests in real estate, has projects going on, I have handymen and contractors that I'm hiring every single day to work on projects. And so when I have a seller that needs to get something done, I can go above and beyond and be a full service agent that makes recommendations to a seller of what to do with their home. I can give them budgets for pricing because I'm experienced with doing some of that work. And then I can bring in the guy or the handyman to get that work done. And having that power will set you so far ahead of your competition. And I almost say that is where the industry is going. And you're going to have, and I've heard mentors, in the Tom Ferry organization and Tom Ferry himself talk about there's two different ways that real estate is going. You have the low, kind of the low commission, no service option where it's just we post your home on the market, and then we have the high service, a little bit higher commission option. And so you're going to have to pick a path as an agent. What path are you going to go down? If you are investing in real estate, you will have all of the tools to be the high service provider to your clients. And I think that is so important. So let's get back to some examples and some tips that I would give for newer real estate investors that are real estate agents. So one of the things that I talked about recently at the Tom Ferry event back in October was adding 6% on top of a sale to roll in your commission towards your down payment and use that to buy a property for less down. So let's talk through an example of this. So since I love the $400,000 number, let's start with that. So let's say we have a $400,000 property and it's off market, okay? So you are a real estate agent. You found this duplex, $400,000 off market. If you go and you put 20% down on that, you have an $80,000 down payment. Okay, not bad, kind of like the option we were talking about earlier. But let's say you're a newer real estate agent, you don't have a whole lot of money. You don't have $80,000. So how are you going to buy this killer deal? Well, since it's an off-market property, you've networked, you found an off-market property. Let's say you've called all of the local renters or the local property managers or the rental database. The city of Minneapolis, for example, has a rental database where you have all of, and most cities do, where you have all the contact info of everyone that owns an investment property. So you go around, you find this deal, but instead of buying it for $400,000, since it's not on the market, you decide to mark it up and get a loan and get an appraisal, and you're going to buy it for $424,000. So you add 6% on top. So why would you do this? Well, because what you're going to do is you're going to go back to the seller and you're going to say, instead of buying it for $400,000, I'm going to buy it for this, but then I want you to credit $24,000 back to me towards the commission. So they get the same net. They get their $400,000. The seller is happy, and now you have this credit. So what that essentially does is, instead of putting 20% down on the property, you're now able to buy it for 14% down. Again, so you're able, as a real estate agent, to go out there and get even more leverage than the 20% down option that I was talking about. And we saw how much more powerful it was to save that 5%. Well, to save an additional 6% makes that way, way more powerful. So, as anything, let's talk about how to make this even more exciting. So let's say now instead of the $80,000, you're saving 24 on top of that. And what are we at? We're at like $56,000. Let's say that's still too much money. You don't have that amount of money to put down on property. Well, let's invite 2 friends in this deal. So you're not just going to buy it by yourself, but you're going to buy it with 2 other people. So what does that mean? That means that you're going to split up the down payment 3 different ways. But you're bringing in your part of the down payment, the majority of your down payment right here. So each down payment is about $28,000. But your down payment is $28,000 minus $24,000 is $4,000. Okay, so you are now buying 1/3 of this property for $4,000 because you put your commission towards the property. So let's talk about that. Every single real estate agent can figure out a way to come up with $4,000 to buy 1/3 of a property. So if you do that, my argument is owning 33% of something for $4,000 is way more efficient than owning 100% of something for $80,000. How much more efficient is it? It's actually 6 times more efficient. So you can buy 6 times as many properties with the same amount of money if you use a strategy like this. So the question that I ask you is not, do you do this deal, but how many times can you do this deal as a real estate agent who is also an investor? Okay, so that is a little bit of encouragement tonight. That is a homework assignment for anyone who has a real estate agent, who has a real estate license, who's looking to get into investing. So a couple other things that I wanted to cover. I also hear about some of the tax benefits. People complain about there's capital gains tax going up. People talk about the potential of 1031s going away. Some of these things that are kind of scary for real estate investors. Okay, there definitely are going to be changes in the future, but just because there's going to be changes doesn't mean that the industry is a scary place to be or something to avoid. It is like anything. This is always a game. There is always a way to play the game optimally. And I just want to give one example. Right now, there are a lot of benefits for solar. So when I was talking about lowering expenses to increase the value of your building, I think there's a strategy right now that works really well for commercial buildings. So units that are 5 units or more to bring down the expenses with the use of solar to offset your power. So one of the biggest benefits right now, besides dividing out expenses and lowering your expenses through solar, is there's a tax credit out there, and it was around like 22%. Don't quote me on this, but it's projected to go up to about 30% in 2022 and beyond. So what does that mean? So it's not a tax write-off; it's a tax credit of 30% of the cost to implement solar in the building. So a tax credit basically gets applied directly towards your tax bill. Not an expense, but a credit. So it's much, much more powerful. So people that are investing in real estate and looking how to optimize their properties, one of the things that I would encourage anyone to do right now is start looking into solar. It can take an average deal and make it look really, really good. It does a couple things. One, it lowers your expenses, but also it adds a lot of value to the building as well. And I think it's one of those things that the government is going to keep pushing and keep incentivizing. And it's one of those things where we are in an industry that doesn't embrace change in technology very fast. So real estate investing is one of those lagging businesses. And if you can get ahead of some of these trends, you can find deals and you can make them into wonderful deals. So one of the last things that I want to talk about before we get into questions here is something that I heard recently called first attempt in learning, fail. So why I'm putting this up there is, there is so much, there are so many barriers to getting into real estate. Most of those barriers are mental, from my experience. Most people put up all of these roadblocks, especially real estate agents, of why they can't and why they shouldn't get started. Some of the things that I think are, some of these mental barriers that block real estate agents. One of the biggest ones is I actually think we know too much. So what do I mean by that? We see too many opportunities. We see too many deals. And there is always a better deal out there. And there's so many people that forget to invest on principles. And they just try to wait for the absolute perfect scenario. And they're afraid to fail. And we're in a very visible industry, and people are watching what we're doing, and they don't want to misstep. One of the other things I hear is real estate agents are too busy. In my office, I see a lot of very productive, very busy agents, and we get so busy helping and serving clients that we forget to invest in our own careers and our own product. We forget that the dollars that we invest and that we make from investing are so much more powerful than the dollars that we go out and we work for in commissions. Why? Because the dollars that we earn from investing can be compounded. They can make money over and over again. They make money while we sleep. The dollars that we make from commissions, we have to go out there and we have to put in the time and we have to work. They go away as soon as we stop working. They don't compound. The other thing is, I think as real estate agents, we are more of the rabbit than the tortoise, right? So we chase, and we're very good at the quick commission deals, where real estate is a slow game, right? It is, it's the long term. And there's a lot of work in finding deals. A lot of times people invest in things that are easy, stuff that is brought to you by financial advisors, stuff that is brought to you by other people, or just going on and just putting more money, into a retirement account because it takes no thought and it's easy and you don't have to do any work to go find the deal. And people consider that investing. And I also think that, it's, again, it goes back to this. There's people are scared of failing. And my encouragement is, to reframe what you think of failing. Because, I look back at my career and how I got started, and very much in many ways, there are a lot of things that I would have done differently. But I would never reverse any of that experience because every single step taught me a ton and taught me how to avoid future problems and gave me a ton of confidence, right? It's all the 1031 exchanges, it's all the rehabs, it's all the construction budgets that went over budget, and the construction budgets that came in on time and on budget, and what did I do differently? And so, if you can reframe things to, look, I'm going to jump in. I know my first deal is not going to be a home run, and it's just going to be a base hit. I promise you will get so much further in real estate investing by jumping in now instead of waiting for the perfect deal. Because with prices going up 6 to 7% a year, because inflation is going to be driving like crazy, inventory at record low levels, I think the investors that get in now are going to look back in 5 to 10 years, and they are going to be very, very glad they bought those first few properties. So I want to take a few minutes here, answer any questions that have came in, and we'll wrap up the evening.
Awesome. Frank asks what your view on short-term rentals is, being that there is typically a larger cash flow.
Sure. Short-term rentals can be great. I have 4 of them right now. So I have a 38-unit apartment building down in Dallas. We've converted 4 of these units to short-term rentals. My advice is find a third-party manager to manage them for you, because realize you are kind of running a hotel with short-term rentals. What we're finding in this building is our long-term leases, we're getting about $1,200 a month in rent. The short-term rentals, after all expenses are paid, we're getting about $1,500 to $1,600 a month. So they're much more profitable. We have someone else managing, so it's a company that just is totally focused on managing short-term rentals. And again, that little difference makes the value of our building go way up. I've managed an Airbnb myself in the past. Did that for about 4 months. Learned a lot of things, but also learned that it is way more active than I would like to be, and it's actually not worth my time to manage it myself. So I'm a big fan. I know some people that do a lot of it, make a lot of money. But I also think that many cities are looking to clamp down on short-term rentals. So be careful when you're buying these properties. Make sure that there's a good plan B, or make sure that you can get out of them, sell them, if next year the city shuts down your ability to run a portfolio of these.
Great. Jake asks, how much do you set aside for reserves? And he's also wondering how much that has changed kind of as your portfolio has grown.
Yeah. That's a very good question. So it's different per deal. So if I'm buying something, myself or just with one other partner, we may set aside a smaller amount of reserves and just know that we have to do capital calls if big expenses come up. So just to give context, I'm thinking of a 7-unit property that I own where we just had a sewer line collapse, and the cost was about $15,000 to fix this. This property is worth about $1 million, and we had about $10,000 in reserve. So that was pretty light. So we had to do a capital call. Myself and the other investor had to put money in But we've been operating this one very skinny with the understanding that if something like this happens, we have to do a capital call. Now, when you're investing with a bunch of other people, capital calls are much more difficult. So if you have 3, 4, 5 investors in on a property, you want much more, a lot more than that saved in reserve. So you want to think about, what is the most expensive thing that could go wrong on that property? What are the top 2 or 3 most expensive things that could go wrong? And then you want to have that amount of money set aside in reserves to do that. So let's say it's a sewer line. Let's say it's, a bunch of the mechanicals, and have that money set aside so you don't have to do capital calls.
Great. Can you give like a quick 30-second overview of what a 1031 exchange is and whether someone who owns 6 doors should be taking advantage of it?
Yeah. So a 1031 exchange, a lot of people know of them, and the concept of them is very easy to understand. But there's a lot of nuances and components to it that I'm not going to cover, but that are super interesting, and why you need someone who is very specific in advising when you're going through a 1031. So in essence, it is taking your proceeds from the sale of a property, rolling it into another property, and deferring your capital gain expense. So if you, in a short amount of time, take the money from a sale of a property and roll it into another property, you can defer the capital gain tax that you would normally have to pay the state and federal government to a later date. The idea behind 1031s is you keep deferring this tax burden that you have all the way until you die, and you pass along your real estate assets to the next generation. You keep your tax burden, you take your tax burden with you to the grave, and they start over with fresh properties with no tax burden. So that is a 1031 in high level, and the strategy for moving forward with them.
Awesome. And then I think for the final question here, Ryan asked, do you have any criteria or qualities you look for when you are looking for potential partners to invest with?
Got it. Yeah, so this is a great question, and this is something that I want to first start with. I am always looking for partners to invest with. So I am someone who is looking at deals all the time, deals that I'm finding, but also interested in investing with other people on deals that they are finding. So I hope that you connect with me. I hope that you follow my Instagram is Eric_Eichhoff. Should be, we can put it up on the screen. So I am always looking for someone. So if you have a deal or you're interested in investing with me, again, I'm always looking for partners. What am I looking for in partners in real estate? I'm looking for someone that sometimes is a little bit creative. I'm usually looking for someone that understands how you make money in real estate, right? So that means that it's not just cash flow, right? It also is appreciation. It also is some of those tax benefits. And again, speaking to real estate agents here, depreciation is one of the biggest tax benefits out there. And one of the things that I want to talk to about kind of on a 2.0 investor level with depreciation is, let's say you put together a larger deal, you bring in a lot of investors, and let's say you're the sponsor of a deal, you're doing a syndication. You can give away a lot of the cash flow to the investors that invest with you. And as the sponsor of the deal, you can keep the depreciation. So if depreciation benefit is something that is not beneficial to another investor because they're not in real estate and they can't write off as much depreciation as you can actually keep other depreciation benefit from other investors for yourself, so you can save more money at the end of the year in taxes, which again is a huge benefit from being a real estate investor. So I know took a little bit of a tangent there from the question, but one of those things that I didn't want to miss on. And really, just to sum up, what am I looking for? I'm looking for someone that's like-minded, someone that's positive minded, that's growth minded. And if you have some skill sets, some financial or analyzing skill sets, that's absolutely a plus as well. Cool. Well, thank you guys for tuning in tonight. I hope that you got a couple little nuggets, and I hope more than anything else, you're encouraged to go out there. We are in an environment where, if you look back to 2009, 2010, 2011, and if you're like, gosh, if we were in that market again, I would go out and just buy the world. Well, I look at today's market, and what if we were in a similar situation? What if we're right on the cusp of property values continuing to skyrocket over the next year because there is no inventory, and because there's no solution for inventory coming up, and because there are millions and millions of millennials that still need to buy, that have great income, that are going to continue to drive the market up, right? So these are some of the things that are actually happening. So what if we're in a similar situation like that? And that's a question that I have for everyone. And that's my encouragement. If nothing else, feel empowered to go out there, to start looking for some deals to invest. And as always, we're a team of agents here at Fulton Realty. We're here to help. We're here to answer questions, and we're here to encourage you and help you. If you're another agent, answer some of your questions to get you started, or if you're interested in investing in Minnesota, we'd love to talk to you as well. So thank you all for tuning in, and we'll see you guys next time.